Half an hour away from the opens at Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with Annabelle Droulers.
Our top stories. Traders assessing President Trump's latest tariff threats, including 25% rates for Japan and Korea, as well as a new August deadline that he now says is not 100% firm.
Secretary of State Marco Rubio set to face Asia-Pacific policymakers anxious over trade on his first trip to the region as DC's top envoy.
And we take a deep dive into Hong Kong's IPO revival as new share sales in the city hit multi-year highs, with a lot more listings on the way. Look, we came into the session this morning and I think if you'd asked anyone, they'd say we were really bracing for impact. It wasn't a great session for the US overnight, and there was a lot of concern being sparked by President Trump essentially offering up or listing out these additional tariff rates that are said to be imposed come August 1. But I think if there's anything we can really take away so far in early trading this morning is that the door's been opened a little bit and you've got that sort of extra breathing space. There's more room now for negotiations, and that is really what traders seem to be paying attention to. So you see, for instance, the Nikkei here climbing, the Kospi standing out 1.5% to the upside. So that's really sort of the key message. Yes, we're facing this renewed tariff fallout, but we don't have it just yet. And so that's what investors can really focus on this morning. And you are seeing that sort of steadiness coming across the dollar gauge, for instance, the Bloomberg dollar gauge. Yes, we did see a jump, but today we're retreating a little bit. You're not seeing that much of a bid into gold, for instance, fairly flat. And the safe havens like the Japanese yen, again, looking fairly steady so far. But it is interesting when you dig into the earnings that we had today as well, because that is really where you're seeing the impact of these ongoing trade tensions between the US and China. Yes, this isn't so much tariff related, it's more on the chip curbs, but the story here has really been clear. You saw a very big dent to Samsung's profit, again, off these chip curbs, given that it's had to find new markets. It's very reliant on China as well, particularly for things like sales of HBM. And so you're seeing here some very much fluctuating moves we've had in the session. Samsung fluctuating between gains and losses, now fairly steady, but again, some of its major suppliers in focus. Going into the session today in China, when you take a look at what we're seeing in futures so far, I think, yes, we're looking fairly steady. I think what's going to be really interesting to watch, what's the kind of signaling that we get with the offshore yuan fixing this morning. Will the PBOC be looking to kind of make a statement with this, maybe push it a little bit lower? Does that also have those sort of second order implications for currencies like the Aussie dollar, of course, very trade sensitive to what's happening in China? Again, focusing more on that FX story this morning. You are seeing a little bit of strength coming so far into currencies, really across the board. Again, that bit of dollar weakness coming through. It's a very different story, Yvonne, to what we had like 12 hours ago.
Yes, we were talking about, is this going to be a mini Liberation Day? You know, are we going to see April all over again? No, right? You take a look at what the moves are, the price action. In fact, it's quite moderate, right? Perhaps the market is taking a bit of solace and finding some solace in the fact that Trump said there is an extension now, right? We have 3 more weeks of negotiations that we could still see here. We could still see better trade deals. And the numbers that we've seen in these tariff rates so far, it's not a huge change from what has initially been announced. So, you know, what you're seeing in the FX markets, where we initially saw that big slump in the yen, big slump in the yuan, we're coming off that a little bit now. So at least maybe we're taking a little bit of relief across what we've been hearing from the president in the last 24 hours or so, right? So he has, though, at least more further confusion over his tariff plans, right? Because there's still a lot of uncertainty out there. And he's flexible when it comes to this new August 1st deadline for deals, just hours after signing off on it.
I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
So let's bring you up to speed, right? The president earlier sent letters to trading partners threatening higher tariffs, including 25% rates on Japan and South Korea. So let's sort through all this and bring in our chief Malaysia correspondent, Stephen Engel. Joining us from Tokyo is our Japan and Korea's editor, Paul Jackson. Steve, I'll start with you. So we have a bit more breathing room. How should we take this latest announcement from Trump?
Well, the market's always a good proxy for how the investors are looking at it. It's not the shock and awe that we saw in early April. What it is a bit of a wiggle room and delay for negotiations to keep on happening. But keep in mind, some of these tariffs that you just saw on that graphic indicate that negotiations didn't necessarily work over 3 months.
No 90 deals in 90 days.
No deals, really. Keep in mind, you have a framework agreement with the UK, a framework agreement essentially with Vietnam, and then you have a trade truce, and no real certainty where that's going to go with China. That's it. Okay, Donald Trump did say that they're close to a deal with India. He did say that this morning. Cambodia has indicated that they're closer to a framework agreement. Cambodia did see their 49% tariff on Liberation Day come down to 36%. But look at Thailand, 36%. That's the same rate it was on April 2nd, right? So their negotiations didn't necessarily pan out, at least right now. Indonesia also 32%, which was the same as in early April. And the real shocker really is Japan and South Korea. I say shocker because it's essentially the same rate that we saw in early April. Actually, Japan was increased by 1 percentage point to 25. It was 24. South Korea stays the same at 25%. But again, this is not including the sectoral tariffs like on steel and aluminum of 50% and automobile tariffs separate of 25%. Keep in mind, Japan is the 5th biggest source of U.S. imports in 2024, and also auto sector accounts for the most of that U.S. trade deficit with Japan. And Ishiba, the prime minister, has been out again saying some lines. We will continue to protect Japan's national interest. It's regrettable the U.S. announced higher tariff rates. This is, though, a de facto extension for negotiations. And we do know that his chief trade negotiator, Akazawa-san, has been to the U.S. 7 times over the last few months, trying to get some movement with very little progress, I might add. Yeah. He did talk with Howard Lutnick at least twice last week, Friday and Saturday. Again, this is what it netted, 25% tariff rate right now.
And Paul, I'll bring you in here because I think when we take a look at the domestic situation in Japan, Korea as well, but Japan we can focus on. I mean, it's not exactly the best moment for Tokyo to be trying to strike a trade deal either.
Well, there are complications. I mean, we have an economy that's been contracting in the first quarter, so there's a weakness there already before all these tariffs come into play. We have a domestic election here for a minority government that's kind of cobbling through, trying to steer policy without a majority, and it's got an upper house election where it could be further weakened. So in a sense, I think there's a huge amount of relief in Tokyo that Trump hasn't really ramped up the pressure on Tokyo. Don't forget, last week he was saying he might go as high as 35% on Japan. So I think there was a lot of, worst case scenarios floating around. And remember that Donald Trump has had a beef with Japan since the 1980s. He took out national ads in 1987 berating Japan and its contribution to the deficits in trade in the US. So I think 25% is a pretty good result for Japan at the moment. And of course, we've got to use the word result loosely because essentially he's kicked the can down the road. And as Stephen mentioned, where are the deals here? I mean, we were promised deals, by the start of the reciprocal tariffs kicking in on July the 9th. So I think what we've seen with these letters is quite a lot of political theatre to cover up for the fact that we don't really have many of these amazing deals.
Paul, you also cover Korea. I'm taking a look at the Kospi, and it's rallying quite a bit on relief of this extension in some ways. But what sort of is the sort of still, needs to be decided with Korea? I mean, they also dealt with their own domestic turmoil with what was happening with the president and the attempts to impose martial law. Where do things stand in Korea now?
Well, I think the situation has been different for South Korea because of this leadership vacuum that followed all the dramatic events of last year and through this year, the impeachment and ouster of former President Yoon. So I think the US has been a bit more understanding that an extension was needed for South Korea. We saw the trade minister in DC at the weekend, and the kind of language that was being used were that negotiations were taking place in good faith, and that's kind of code word for you've got an extension. So this is kind of confirmation that the talks can go on. Both Japan and South Korea will continue to seek a deal and try and get these tariffs down during the intervening period. I think South Korea, on a similar tack to Japan, is trying to promote the idea of investment, partnerships in manufacturing, helping US in those respects. For South Korea, there's also been quite a lot of talk about digital restrictions and how this impinges on US tech companies. Now, if you've seen Donald Trump, how he responded to digital restrictions in Canada and how the Canadians kindly had to back down on that, you'll know that the US does take those matters very seriously.
And Steve, we've got Secretary of State Marco Rubio heading to Malaysia. I mean, he's probably going to be wanting to make the case, look, I'm not responsible for these trade negotiations, or I'm not leading them, but I mean, you can bet it's going to be coming up in a lot of conversations.
Well, I think he has a lot of answering of questions to be done, obviously because of the ASEAN nations that have been hit so hard by the tariffs. And Indonesia, is one of them, 32%, no difference from the initial tariff. And they had also indicated that they were about to strike a bold agreement with the United States. But keep in mind, Indonesia is also a relatively new member of BRICS. That was the whole story yesterday about Donald Trump warning BRICS nations to not abide by essentially some of the calls by other members of the BRIC nations to condemn U.S. policies, not only in the Middle East, but on what they see as a unilateral trade policy by the White House. So again, Indonesia in a bit of a tricky spot, but Indonesia had indicated that they were close to a deal with the United States on critical minerals, energy, defense cooperation, market access. Thailand, too. Keep in mind, Thailand, same reciprocal rate at 36%. They had been making a number of last-ditch efforts to avoid that tariff rate, greater market access for U.S. farm and industrial goods, possibly buying more Boeing jets, purchases of U.S. energy. But as Paul just indicated, where did these negotiations get them right now?
Yeah.
It got them the same tariff rate, essentially. Well, actually, Indonesia and Thailand, exact same rate, and no promise that in 3 weeks there's going to be any progress. So, yeah, I think the ASEAN meeting and Min Min Lo, the China correspondent and Malaysian, is there. So we're going to get a lot of updates from her on that ASEAN meeting with Marco Rubio there.
Yeah, we'll be certainly going to Min Min for all the latest there, but that was our Chief North Asia correspondent, Stephen Engler, as well as our Japan and Korea's editor, Paul Jackson. Really great way you put it there. Political theatre is maybe what we're seeing, but we're going to get more details on this, the impact that it's having as well on companies and different business operators across the US. We'll be speaking with the CEO of the Footwear Distributors and Retailers of America very shortly, again on the impact of tariffs and on supply chains, retail prices as well.
And subscribers can also turn to the terminal for more on this. T-Live Go is your function for the latest updates, plus commentary analysis from our expert editors. Plenty of sort of headlines that we got to dig into in the next few hours or so. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Just got the yuan fix crossing this morning, and we have seen it coming in at 715.34. The estimate had been for 717.96, so pretty much kind of a fixing that we've had in line over the past few days. But certainly we have seen both the offshore and onshore yuan really under pressure, and that was not just with President Trump sort of ratcheting up these tariff threats, but also really putting any country that aligns with the what he would say is the anti-American policies of BRICS, but very much in the firing line.
Yeah, and I think the PBOC, I mean, this is stronger than expected by quite a bit. So in a way, they're trying to send a signal of maybe they are sort of maybe anchoring those expectations that they are still leaning into strengthening or at least keeping this as currency stable for now. Joining us is Amy Shea-Patrick, head of income strategies at Pendal Group. I take a look at what's going on in bonds, Amy, and it's quite a confusing backdrop right now, right? You see this push and pull between what the Fed's going to do, whether rates are going to be cut, and you kind of square that with all these macro themes of tariffs and fiscal deficits that might widen due to this big, beautiful bill in the U.S. What matters more to you now?
Look, I think what's mattered for me for bonds all the way through is trying to kind of steer clear of the macro headlines and the noise. Because as you see, one day tariffs and OBA matter a lot, and the next day they don't. And the market likes to discount these waves of headlines as time goes on. For us at Pendal, what we continue to focus on, not just for bonds, but for every asset class, is what ultimately does matter, cycle after cycle, regime after regime. And with bonds, it's going to sound really boring, but I'm focusing on what is going to happen to the inflation picture, both near term and longer term, and also where is growth headed. And I think, on the inflation side, the market continues to be really surprised that you're still not seeing, to a large degree, any feed through into CPI from the tariffs that have been levied so far. And, whether it's producers eating the costs along the way, whether it's the exporters, eating some of the costs along the way, or whether it's just delays because for contractual reasons, maybe some of these price hikes can't be passed through. I'm not sure. So near term, maybe we need to worry a little bit about inflation. But longer term, I think the trajectory for disinflation is still well anchored when you look at the wages picture in the US especially.
So then what does that tell you about the expectation for Fed easing? How many cuts are you looking at this year?
Look, I think I would err on the side of slightly more than what the market's been pricing in, and that's not just because I work in fixed income and I've been trained to like bonds, but really it's to do with the risks and the direction that they're tilting towards, right? So on the inflation front, as I just said, when you look at the loosening that continues to happen, albeit gradually, in the US labor market, it does underpin the wages picture. When you look at shelter inflation, that's well under control as well. So we'll get a little bit of a bump probably on CPI due to some of these tariff effects, but they will, and I hesitate to use the term, they will be transitory, in my opinion. But on the growth side, I think you will start to see a little bit more weakness coming through. I mean, we're still waiting to see, the follow through from the crash in capex intentions when you survey small businesses and large businesses across the US. And a little bit of softness probably does, alongside a disinflationary picture, probably does warrant 1 to 2 more cuts than what has been currently priced in by the markets for the US.
How do you look at positioning in this market right now, and how difficult, Amy, is it to be a bond trader these days, given all these sort of conflicting forces that are impacting where this yield curve goes?
I think it really depends on what kind of a time horizon you hold as a bond trader. Look, for us as active investors in fixed income, we go in fixed income wherever we think the lowest hanging fruit is. And, you can probably judge by all of the push and pull forces we've been discussing so far today. There is no clear direction near term for bonds right now. I think you'll have a couple of moments in the year, and we probably already had one of them already. That was the April episode, where bonds will look really attractive and they'll look like a bit of a shoe-in. Definitely not one of those moments for your typical, high-grade government bonds right now. But there are other places in fixed income that I prefer. And, again, it sounds boring, but fixed income is boring, and it will be your accrual type trade. So it'll be credit, and maybe even going a little bit further up the risk spectrum, because as we know, default rates are well under control, even in the high yield space, and reaching a little bit further out for just that little bit more carry. Still focusing on, the quality of the balance sheets that you're buying into is probably the lower hanging fruit in fixed income right now. And I'm waiting for the data to show me a more concise set of signals for that second moment in every year when bonds have a really good time.
We've got a couple of different key bond auctions coming up this week, but in the US, for instance, 3, 10, 30-year just this week alone. So what sort of demand picture are you looking at?
We've been tracking what the demand picture has looked like for US auctions over the past few months, actually. And for all the fears that, maybe foreigners, especially the Asian central banks, the ones with, net high savings, are starting to buy less and less of US treasuries, you're not really seeing that come through in the overall data. I would say, though, that there is a bit of a question mark on the very longer dated issuance. And, Scott Bessent has also said he will issue to wherever the demand is. I think that for the way that the yield curve is shaped, the demand is probably still going to be more at the front end of the US curve than towards the back end. And the back end will continue to suffer from, these structural issues about illiquidity. Who really uses 30 years? And of the bond traders in the world, who really manages their duration using a 30-year bond or even a 30-year future compared to something more standard such as a 5-year or a 10-year. So I do think the liquidity issues will continue to plague the 30-year part of the curve, and it just may mean not necessarily higher yields overall, but maybe higher volatility overall at the longer part of the curve. But I continue to see, decent takedown of the shorter to belly of the curve type auctions coming out from the US.
Amy, you mentioned that you don't really want to talk about whether, treasuries are still that risk-free haven and whether that's in jeopardy right now. But you mentioned in your notes that, bonds were never designed to be the slave asset class to stocks. Can you explain that a little bit?
Oh, absolutely. Look, I actually spent, maybe the first 10 years of my career as a bond trader, a fixed income trader, thinking, when equities have their moment, when equities have a severe drawdown, you've got to own bonds because that's what happens, right? Bonds are supposed to rally when equities have a big drawdown moment for whatever reason. And, 2022 showed us all across the world that, this is plainly not true. And I come back to my earlier point at the beginning of this show where at Pendal, we really do focus on the fundamentals that drive bonds. So if you're in a situation whereby, you do have significant growth concerns ahead of you, but at the same time, inflation is just not under control. These are what we call the fundamental push and pull forces on bonds, right? And in that moment, equities aren't going to do well, but bonds aren't going to do well either. So what I mean by the statement that bonds are not a slave asset class to equities is that there's just nothing intrinsically within bonds that tells them they have to rally when equities sell off. So in terms of, discussing the overall haven nature of, the argument that's going on about whether US Treasuries can continue to be your safe haven going forward, I think for me, it comes back to this overall discussion that let's not pretend that bonds will necessarily be that defensive ballast against equities in every equity sell-off.
Really great insights this morning. That was Amy Patrick, their head of income strategies at Pendal Group. Thanks very much for joining us this morning. And counting down to the open of trade in Hong Kong, Shenzhen, Shanghai, futures are looking like this, and we'll have more details just ahead. This is Bloomberg. Just a few minutes away from the open this morning, and we are actually seeing futures pushing higher here. Hong Kong up 0.2% in pre-market, but investors seem to be shrugging off this risk of additional tariffs. Welcome back. You're watching the China Show this morning, and we're counting down to the open of trade. Look, actually, the day is looking like it's going to end up being a bit more positive than perhaps we could have expected. Yes, we had a bad day on Wall Street overnight, but coming into the session this morning, investors do seem to be taking some relief in the fact that President Trump, we do have this prospect of additional tariffs, but we do have a larger window now for negotiation.
Yeah, and those tariff rates, as announced, did not really change too much from what the initial threats were, right? So you got to wonder 90 days, what was actually achieved? That certainly is one question, but at least there's 3 more weeks of negotiations possibly between nations in the U.S. So I think the market is taking that as positive news, that the can has been kicked for another month or so. So certainly that's one thing that we're dealing with here is a bit of a relief rally, right? Especially in Korea. We're up about more than 1% on the Kospi here right now. But yes, you take a look at how the onshore markets are dealing. It's pretty much flat right now. Keep in mind, the tariffs that we got in the last 24 hours or so had nothing to do with China in some ways. So therefore, we're not really seeing that big of a hit, I guess, directly when it comes to China here today. We're flat when it comes to some of these benchmarks here as well. We're watching very closely what happens with Shanghai crude. That's up about 1.5%. So you're still seeing at least a bit there when it comes to oil markets there. And you take a look at some of these big names, not a whole lot of movement in the likes of CATL or Medea Group here this morning as well. Flip the boards. Certainly Hong Kong is one to watch here. We're going to have a big deep dive segment into the whole IPO market with Hong Kong Exchange a little bit later on. But yes, you're seeing modest gains at best here. But certainly the fact that you are seeing a bit of relief even when it comes to the dollar now. So the big move initially was the slump in the yen, slump in the EM FX currencies, the worst day since April. And things are coming off now, right? So certainly that's helping overall lifting boats here in risk assets this morning. But yes, you are seeing there's still some weakness in the yen, but look, you're seeing more strength coming through in the yuan, in the South African rand, but we're still seeing that weakness in the Brazilian real. So there's still a lot of uncertainty about what this means to the whole EM FX complex, right? Because the dollar actually did gain a bid and actually rallied and gained the most for some time. But then that's now losing a bit of steam because the euro is gaining once again, because there was reports from Politico saying that the U.S. might be ready to strike a deal with the EU at 10% tariff level. So that certainly is lifting the euro this morning and maybe reversing some of the gains that we did see in the last coming hours or so. U.S. futures are pretty flat right now, so I guess we'll take it as good sign that things are not selling off massively. And you take a look, even like some Goldman just raised their 12-month price target for the S&P 500 to 6,900. There are still bulls out there that think this equity market can rally back to those record highs. So certainly that's one thing to watch very closely. Gold, it's not doing too much as well. So the havens are not really getting bid up. Treasury yields actually headed higher overnight as well, despite some of the risk-off moves that we did see initially, Belle.
Yeah, let's talk about the impact, of course, all of this tariff news and the reaction to it as well for businesses with Matt Priest. He's president and CEO of the Footwear Distributors and Retailers of America, joining us this morning from Washington. So thanks very much for making the time for us. You're dealing with a lot of different businesses, and I think what makes the U.S. footwear market so unique is that, maybe you manufacture 25 million shoes or pairs of shoes in the U.S. per year, but you're importing more than 2.3 billion. So right. A lot of these shoes have to come in from abroad. How are you interpreting the tariff agreements, or at least ceasefire that we had so far, and what was announced overnight as well?
Yeah, these are all great questions. For us, 99% of shoes sold in the U.S. are made overseas. You just mentioned the billions of pairs we bring in, and majority of our shoes come from just 3 countries: China, Vietnam, and Indonesia. So as an industry, we have to look at each of those countries and where they fall within this different matrix that the president and his team have laid out there. You have China on pause till August. You have Vietnam with the framework that was announced, but no details have been released. And then you have Indonesia that received a letter today from the president. So we've got a ball on each of these courts, and we're trying to best plan and prepare in an inflationary environment where we already pay high duties, and we have a concern that while there's a reprieve for a number of weeks, we're going to continue to see high duties, and that will drive up prices for consumers. And I can tell you that our consumers are weary, they're worn down, but that's the environment we find ourselves in right now.
You've been working the phones, Matt. You've been saying for the last few hours, and I'm guessing this weekend as well. What's the overall sentiment like among some of your footwear distributors out there, and on these tariffs, and are they assuming higher tariffs moving forward?
Yeah, that's a great question. So we put out a Q2 survey, like an executive survey of our members just a week or two ago, and they all see the next 6 months as very difficult, a very strained American consumer that's worn down by increases with the potential of higher prices, particularly as we head back to school. And so they already have kind of a dour look of at least over the next 6 months. And so what we find now is that the jerk and the pull and the push as it comes to policy it's very difficult to plan. But I can tell you there's a resiliency, and at this point, our industry is saying to themselves, we just need to wait till the dust settles. We need to understand kind of the full bingo card before we get back to making sourcing decisions that are critical to our businesses. And so until we understand what the tariff rates with the negotiated outcome with Vietnam will be, until we understand where Indonesia lands come August 1st, where the Chinese are headed, it's going to be really difficult for our members to make any kind of strategic decisions from a sourcing perspective. And I can tell you, we've been diversifying since 2010, so we know how to do it. But right now, you just don't know what, where the landmines are relative to the sourcing landscape. And until those rates are set, we're not going to be able to make those kinds of decisions.
Matt, that U.S. and Vietnam trade deal, what came part of it was that 40% tariff on transshipping from Vietnam. It seems like it's an indirect way of trying to at least deter activity from Chinese exporters to reroute some of their products away from Southeast Asia. How effective do you think that's going to be?
Well, there's a little confusion in the marketplace, to be honest with you, Yvonne. So we know that transshipment is already illegal. So routing products through illegally or mislabeling them from an origin perspective is not permittable under U.S. law. And our members know this very closely and intimately. And so they work very hard to ensure that they abide by U.S. law. What I think the administration is getting at is relying on materials to flow through. And under current law, at least for footwear, we have this tariff shift rule of origin. So origin is transferred to the country where the last substantial transformation takes place and then exported to the U.S. market. And we've been utilizing that for a long time. Our concern is that with any of these reciprocal agreements, if there's a really high threshold that requires materials to be sourced from within the countries of the agreement, our members won't use it because they won't have the ability to bring those materials in, at least right now, to start to fully integrate their supply chains within that home country. And they just might just go back to China. So we've been advising the administration that if they go down this route, one, it's a heck of a thing to enforce, but two, the other consideration is the fact that it just takes time for our supply chain to catch up and for those materials to come fully into the production country. And they got to give us some time to do that, to comply with the new arrangement, whatever that rate might be.
Yeah, on that point I mean, lobbying is a key part of your role. So how have the conversations been with officials in Washington, and are they listening to your concerns?
We have found the administration to be open and to conversation, to discussion, and to our point of view. Clearly, the President of the United States has to make the final decision based on what he thinks is important for his agenda. We continue in a very respectful way to push back when we think that driving up prices on American consumers on products that they have to buy and have to buy from overseas sources is not the way to go. The president's mandate was to lower prices on day one, and adding billions of dollars in new costs on American businesses will not do that. And we were encouraged when the president just a few weeks ago said at the tarmac outside Air Force One that he wasn't looking to prop up domestic production of footwear with these policies. So our hope is that as negotiators continue to finalize these reciprocal agreements, that they might actually build out a little bit of nuance amongst the tariff rates, and so that we're not hit as much or not at all, to be honest with you, while they look at maybe more strategic industries. And so that's been our focus. We continue to be the voice in the industry with the administration, as well as with our trading partners and the negotiators within the trading partner countries, to ensure that they're coming to the table with a robust offer and an openness to negotiate. And that's been critical, I think, to our continued success as we engage with both sides.
Can you tell us more about what the cost pressures some of your members are facing here right now? I mean, just given where tariffs stand right now, I mean, how much more is a pair of shoes going to cost now to consumers? And what does it mean for the whole CapEx cycle for some of your members?
It's really difficult to really articulate how historic this time period is, to be honest with you. When the president announced on April 2nd, Liberation Day, from the Rose Garden of the White House, he was focused in on driving up tariffs. And for us, we were going to go under his new plan from about $3 billion a year in tariffs to $10.2 billion. Now, clearly, those numbers have come down, but the fact of the matter is we still are going to have record tariff collection on top of our industry. So that's going to be record prices going up. In fact, we saw in April just alone, tariffs on kids' shoes went up nearly 300% year over year. And so when we look at those kinds of increases, the front loading that took place to avoid some of these tariffs so we can get those goods to U.S. consumers at price competitive levels, we're going to see a consumer that's, as we head into back to school, around that August 1st date that now we all have our eyes on, we're going to see higher prices. And most of our brands have announced that they're going to have higher prices. They've said it publicly, they've said it in public earnings, they've said it in partnership with their retail partners. And so it's an inevitability that this is coming. And I think the challenges for the American consumer, it's not just footwear, it's everything. Everything is being hit right now.
Yeah.
And so the shotgun approach is going to be inflationary. So much so, Chairman Powell said he didn't lower rates because of the tariff considerations. And I think we're going to see that hit consumers here very soon.
Matt, shoes are interesting because I guess there's varying elasticity of demand. I mean, things like school shoes you may need, but you may not need that latest pair of sneakers, for instance. So what's the impact to businesses? And do you also speak with businesses that think that they actually just can't survive the impact of higher tariffs?
Yeah, I would beg to differ. I think you always need a good pair of sneakers, but we can set that conversation aside. I think ultimately we're an industry where sometimes we are recession-proof. Sometimes consumers are not going out and buying, automobiles or washing machines, and they're picking up a nice pair of shoes. But I can tell you many times when we see prices go up, inevitably sales go down. And prior to this inflationary period we expect to come into, our sales have been down. The consumer is spooked, and that obviously concerns us. But I've talked to hundreds of footwear companies, and all of them are positioned a little bit different in the marketplace. But one in particular stands out to me, and this is a company, a family-owned company, importing shoes from China, 100% China, and they make a shoe that had a 6% tariff on it. They brought in $1 million worth of shoes every month. They had a $60,000 duty bill. That duty bill went from $60,000 to $1.5 million for a time, and now is down to $360,000. And you can't survive when you have a cost that's 6 times what you expected in a very short amount of time. And so they're doing everything they can to stave off extinction. But I've had these conversations over and over and over again. It just speaks to the nature of we're an industry that went out, that blazed trails, that found great product for our consumers and brought those back to our shores. And now our own government is punishing us for doing that, for being innovative, for exploring, and for finding great product and working with producers all over the world. And now we're left holding the bag with these higher tariffs, all the while the White House says we're not a priority from a domestic production perspective. So we want the policy to line up with the rhetoric, and we're working towards that right now.
All right, Matt. Thank you, Matt Priester, President and CEO of Footwear Distributors and Retailers of America. And subscribers can watch us live and see our past interviews in our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation. Send us instant messages throughout the shows. Check it out at TV Go. All right, it is Happy Birthday Bond Connect. That anniversary ceremony is underway here in Hong Kong this morning, and as they mark, of course, is opening up. And they announced a little bit of this, right? So the HKMA chief, Eddie Yu, did speak about this and saying that, look, the southbound Bond Connect to include brokerages and insurers, and they are going to be expanding the offshore renminbi repo business as well and increasing that bond swap transaction limit. That's what we've been hearing from the PBOC officials there this morning there as well. So certainly some good news coming through there.
Yeah, and it also is interesting in terms of the timing because we did have a really great Bloomberg scoop on this yesterday, talking about also the plans around the southbound Bond Connect, looking at maybe doubling the amount that investors or local investors can use to buy bonds overseas. That's according to sources familiar with the matter, but essentially maybe looking at expanding this program to as much as 1 trillion yuan or around 140 billion US dollars. But for more on this, let's bring in our China credit reporter, Trista Xinyi Luo. So, Trista, I mean, just based off what Yvonne said there, also your reporting, how are you, talk to us about this scoop essentially.
Yeah, so we heard from sources that the annual quota will be increased to 1 trillion yuan, and it will also allow non-bank financial institutions to join this. and which means like the local investor can ramp up exposure to international bonds listed in Hong Kong Stock Exchange, including the dollar bonds and also offshore yuan-dominated bonds.
What's the bigger picture? What's the goal here?
Yeah, I think it shows Chinese government effort to loosen up its control on financial flows and also trying to boost its international appeal of the yuan. Like China has been criticized for years about its capital control, which means its market is obviously close up of the rest of the world. So I think that shows part of its effort to do that. And I think this also offers more local investor for more higher yield products, compared to onshore products. Obviously, offshore products have better yield.
So what would be sort of the timeline? I mean, we just got this expectation that we are going to see further expansion, but do we know anything more on when we would expect it to take place?
Yeah, we haven't heard from sources about the timing, but if it comes true, it's actually a good news, right? And I think it also shows Chinese officials comfortable about trying to push more about the yuan's internationalization. As we all know that the dollar has plummeted a lot this year, so I think they seized the chance to do it right now.
All right, Trista, thank you. Trista Luo there, a Bloomberg China credit reporter with the latest when it comes to Bond Connect. In some other corporate headlines that we're tracking this morning, Bloomberg has learned that Apple's top executive in charge of AI models is leaving the company for Meta. Sources say Roming Pang is joining Meta's new superintelligence team after being offered a package worth tens of millions of dollars per year. Pang joined Apple from Alphabet in 2021 and had been running a roughly 100-person team responsible for the company's large language models. Epic Games has settled its antitrust case against Samsung Electronics. The suit alleged that the electronics giant conspired with Alphabet's Google to block rival app marketplaces through default settings on Samsung mobile devices. The Fortnite maker says it's grateful that Samsung will address its concerns, but didn't elaborate further. Plenty more ahead. This is Bloomberg.
Well, Samsung has reported its first profit decline since 2023, partly citing the impact of US chip curbs on China. Our team at Bloomberg Intelligence says pressure from those curbs as well as US tariffs will continue to weigh on Samsung's numbers. For more, let's bring in Bloomberg Intelligence senior technology analyst Masahiro Wakasugi. And Masahiro, I mean, these numbers, very, very far short of what analysts had been expecting. But just break it down for us, just in the preliminary figures, what stood out to you in particular?
Yes, the Samsung operating profit was around 26% lower than the consensus, but partly that was expected already. And if we look at the Samsung's earnings, probably foundry business is making quite a big loss. That is affecting the overall operating profit. And the operating margin in the second quarter preliminary number is around 6.8% operating margin, which compares with over 40% operating margin for SK hynix in Q1. And Micron's operating margin was also high, above 20%. And Micron is expecting over 30% operating margin in the coming quarter. So maybe the situation is not really good for Samsung, and partly because of foundry business. But as you can imagine, that their HBM memory chips, it's used for the AI function. The HBM business has been quite struggling with improving profit, production yield. So that is also affecting their operating profit at this point.
Yeah, it's interesting, right? Short term, it seems like Samsung's profit might be trailing the likes of SK hynix, but Morgan Stanley has an interesting note saying that they see a credible bull case around HBM4. Are you not as optimistic, Masa? What's your take overall?
Yes, now the main competition is about the HBM3E, and HBM4 will be coming next year. And I kind of sense that Samsung may have to catch up with quite aggressively, because Micron is already supplying HBM4 chips as well as SK Hynix. So competition has already started, and HBM3E generation, Micron and SK Hynix are already leading. So I think that Samsung may have a chance to catch up, but still a bit of long way to go in terms of HBM4. So maybe we have to watch the situation very closely going forward.
Masa, thank you. Masahiro Wakasugi there, Bloomberg Intelligence Technology Senior Analyst, joining us out of Tokyo on those Samsung earnings. We're just getting some lines here, getting some reaction from the Thai government. This is the Ministry of Finance Chief Chui, reacting to, of course, this August 1st deadline and saying that they were a bit shocked about this 36% U.S. tariff rate, but they should be wrapping up talks by that August 1st deadline. So, of course, we have been able to push back, at least push a little bit later, this deadline. So certainly maybe that gives them a little bit more wiggle room, breathing space to see if they could bring up a better offer. But yes, they were a little shocked, to say the least.
Well, yeah, I mean, they were one of the countries to receive a letter in the first batch, and the US looking to impose 36% tariff on goods from Thailand, also from Cambodia. So certainly we'll be feeling the effects of that. But coming up in the next hour, we're going to be talking about the impact of all of this, particularly on emerging markets in this region with HSBC. I will also take a deeper look at the IPO market in Hong Kong, as what has been very much a banner year for listings in the city, but we'll have plenty more ahead. You're watching The China Show, and this is Bloomberg.
Welcome back to the second hour of The China Show. Here's a look at the HSI a half hour into the session. And, it seems like things are looking okay here after these latest rollout of tariff announcements from President Trump. We started the morning thinking that it was going to look bad, like maybe another April sell-off. But then again, you hear from President Trump saying, look, that August 1st deadline is not 100%. There's more room for negotiation. So I think markets right now, Belle, really focus on this tariff extension deadline more so than the tariffs itself.
Yeah, just really opening the door. And I think actually what's interesting when you look across markets in Asia this morning, Hong Kong is also standing out just for the amount of trading volume. So you're seeing volumes that are actually pretty heavy in this market this morning, but across the rest of them, it's actually well under the 20-day moving average. And so, yes, we've got this door that's being opened. Investors are probably still just really pretty nervous and a bit more in the wait-and-see mode as well, so not too much conviction. But what you do see is at least some relief that's coming into markets like the Kospi, for instance. Also notable because you had those results out for Samsung, the heavy weight on the benchmark, and you're still not seeing heavy losses there, even though we saw really the first profit drop going back a couple of years. But in the session today, there has as well been that big focus on currencies again. We had that expectation. We had the hit to EMFX overnight. It hasn't translated into the session so far this morning, but the Korean won was very much the standout yesterday. Today you're seeing that bit of strength against the greenback here. The euro, of course, and this is sort of the big wild card in all of these negotiations because we've got this reporting out from Politico this morning, but essentially the EU could have been offered a 10% tariff deal. Again, we'll get into the deal that does, or the details of that. It certainly does carry some caveats. And then, of course, watching Toyota, the Japanese automaker, or the auto sector in general, are very sensitive to these tariff results. But again, just that can that's been kicked down the road a little bit, it seems.
Yeah, let's get to our top story here right now, which is President Trump has sown some further confusion over his tariff plans, saying he'll be flexible on a new August 1st deadline for deals, just hours after signing off on it. Now, the president earlier sent letters to trading partners threatening higher tariffs, including 25% rates on Japan and South Korea. Let's sort through all this right now by bringing our Bloomberg chief North Asia correspondent Stephen Engel, our Japan and Korea's editor Paul Jackson joins us from Tokyo, and maybe the Southeast Asia impact as well. Our economy reporter Claire Zhao is in Jakarta for us. Steve, let's start with you. Some rates are higher, some are lower, some are the same. But what does it tell us about where trade negotiations stand right now?
Well, I think they are ongoing and that the 3 months really went by pretty quickly. And there have only been 2 framework agreements and a trade truce announced by the White House. So you had the UK and Vietnam having agreed to a framework of trade truce, if you will. But then there's a trade truce with China that does not necessarily guarantee that it will hold water and be a lasting truce. So again, there are a lot more negotiations still happening. So this just buys a little bit of time while also reaffirming Trump's commitment to putting these tariffs on a number of different countries, some of which did not come down. Some went up as well. So I think it's just that's why the market's reacting the way it is right now. They're seeing this as essentially more time to get negotiations done. I was just seeing a comment from the Ministry of Finance out of Thailand saying that 36%, which didn't move at all from April 2nd, was quite shocking, but that they hope to conclude their negotiations by August 1st. There are many countries here, and 90 days was too ambitious to get a lot of them done. Of course, the White House promised quite a few more deals would be done by this time, but it just didn't happen. There was also, some of the attention in the White House was derailed by what happened in Iran and some other issues as well. So we'll see if this does buy them time and get more deals done.
Yeah, and on the topic of getting more deals done, I mean, countries that really would be agitating for that, of course, Paul, Japan and Korea, 2 of the US's main trading partners in this part of the world. What are the expectations and what are we sort of seeing as the major sticking points that are holding back a deal being signed?
Well, I think for the case of Japan, Donald Trump for decades has had a beef with Japan over cars and the amount of Japanese cars that get sold in the US without, he says, any cars, US cars being sold in Japan. That's not actually the case, of course. There are American cars here. They are rather large, rather difficult to get around narrow Tokyo streets. But when you look at the trade deficit with the US, it's the 7th largest. Korea's is the 8th largest. About 82% of that trade deficit with the US is down to the cars. So is he going to give ground on that 25% sectoral tariff on the cars? Now, the Japanese side, they want to get all this negotiation with the reciprocal tariffs all done in one go with the auto tariffs. They don't want to sign off on a deal for the reciprocal tariffs and then leave the sectoral tariffs on the autos in place. So that's been one of the big sticking points, because from the US side, they're kind of wanting to get the reciprocal tariffs deal done and then leave the auto tariffs kind of in the bag there. So Japan's wanting an all-in-one kind of deal. So that's been a sticking point there. Over in South Korea, we've had a leadership vacuum there, so it's been very difficult for negotiations to pick up until President Lee was installed. That's early last month. So an extension was kind of always kind of on the cards for South Korea. Among the sticking points there, I mean, there's also autos is another huge part of the deficit that the US has with South Korea too. We've also got chips to a lesser extent. And also has been flagged problems with the US tech firms on digital restrictions. And as we've seen with what happened with Canada, the US take those very seriously.
Claire, jump in, maybe talk a little bit about what's happening on your end. We're seeing Indonesian markets open right now. Not a whole lot of movement there, but that 32% tariff rate seems to be the same, unchanged. What's the response from Indonesia this morning?
I think the major reaction out of Indonesia is really shocked because until hours last night, we were still expecting that Indonesia was very close to signing what it called a bold deal with the U.S., which involved around $34 billion in trade and investments. In fact, our negotiators had already pledged that they would buy more U.S. gas, wheat, and even Boeing jets, even pledged preferential access to the country's critical minerals, and even said that they would cut tariffs for U.S. imports to near zero. And suddenly, last night, all of that became radio silence. So we're still chasing details from the government on what exactly went down. It could still be true that Trump is just buying time until the August 1 deadline to negotiate more with its Indonesian counterparts. But it could also be true that Indonesia may have overplayed its hand, and it's not really in a strong bargaining position as it expected. It was hoping to get a tariff rate lower than Vietnam's, lower than 20%, in the hopes that it could get some FDI coursing back into Indonesia because a lot of its factories are already closing even before the trade war.
Steve, we can bring you back in here because I think sort of two of the deals that we're really also anticipating are India and also the EU. But what's going on? Because we've had sort of some announcements or sources-based information coming through on both of those this morning.
Yeah, and I was just listening to Claire, and they're in a state of shock in Indonesia right now because Indonesia did think they were getting much closer to a bold deal. Now, is that a harbinger for what's going to potentially happen with India and the EU? Because there's been optimism over a possible India deal. And in fact, India has said, well, we are pretty much done. And I'm paraphrasing. We're pretty much done negotiating with the United States. We have put together a good proposals. It's now in the hands of Donald Trump. And essentially what sources are saying, it's up to Donald Trump and Narendra Modi to come up with some sort of agreement between the two of them. There are red lines in India because of the agricultural. There's the huge farm constituency in India that is tied to Modi's party. They don't want genetically modified crops to come from the United States into India. They don't want dairy necessarily. And then there's also issues over automobiles. So we'll have to see on India, okay? Yeah. They might be close. The EU, there's optimism there as well that they could possibly cement the EU, that is, a baseline 10%, which would be, comparatively speaking, a good deal, right? But again, this could fall apart as well. There are a lot of contentious issues. Donald Trump has been quite vociferous against some of the protectionist measures in the EU, so we'll have to wait and see on that. There's optimism. There could be deals over aircrafts and parts and, wine and spirits. But you just simply don't know. Again, I think Claire was spot on with the shock that is happening in Jakarta right now. They thought they had a deal, and wham, they got 32%, which was the exact same reciprocal tariff back in April.
Yeah, certainly just the content of these letters and also who's going to get the letters next, because we know that more are on the way. But
we could spend a whole show going through country by country, but we're not.
Yeah, we absolutely could. But that's our Chief North Asia correspondent, Stephen Engel, there, as well as our Japan and Korea economy editor, Paul Jackson, in Tokyo, and our Indonesia Deputy Bureau Chief, Claire Zhao, in Jakarta. And actually just on that sort of Southeast Asia angle as well, this is another country here just talking about this morning, Malaysia. The Trade Ministry just noting in the last few moments that they're saying that they're continuing to engage with the US on tariffs. They're also saying as well that these efforts to discuss with the US are ongoing, but that constructive engagement and dialogue, they also say, are the best path forward.
Yep, and I'm taking a look at when it comes to the ringgit here. Continue to see a bit of weakness there on the back of these tariffs, so certainly one to watch here. Given just the sort of slashing that we saw at EMFX, that has at least stabilized in the Asia session here today. There's more ahead, though, on how these latest threats could impact Asian economies. We have Fred Neumann from HSBC joining us next on The China Show. This is Bloomberg.
I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
President Trump there speaking after issuing letters that threaten higher tariff rates on trading partners, including some in Asia. Let's bring in Fred Neumann now, Chief Asia Economist and co-head of Global Research Asia at HSBC. Fred, 90 days of trade talks, seems like we've yielded the same sort of tariff rates since Liberation Day. Has anything changed in your eyes?
Not really. We got a three-week reprieve, right? So essentially it's saying, look, we're going to go back to April 2nd levels unless we can get a deal in the next 3 weeks. And so it's basically extending the deadline a little bit. It's tight, 3 weeks. But I'm sure that countries are not going to scramble to try to fix a deal just before August 1, because you can't extend forever, right? Otherwise, the TACO kind of label really sticks. So I think there is some pressure really to come to some deals by August. But that really, the markets haven't reacted, and so really today is just a 3-week extension, more or less.
But we were talking earlier with Amy Shepatrick about the inflation impact and how it's not really feeding into consumers just yet. So what's your expectations around price pressures, and do we start to see any building, do you think?
The soft and hard data. When do they actually start
so eventually you would. And of course, markets are very impatient of saying, well, we had tariffs already, why isn't it showing up? But the reality is that actually the tariff level currently is nowhere near as large as it will be probably later this year once we get some of these reciprocal rates actually start to kick in. The second issue is that we saw a lot of front loading ahead of the tariffs. So you have high inventories in the U.S. and really retailers are just reluctant to raise prices too early. But at some point they will have to, because once they start to buy new goods under the new tariff regime, they'll have to pass on some of these price increases. And so I think we're first panicked about inflation. Now we're saying there's no inflation at all, and probably there's going to be some inflation that will come through eventually on this.
So we're just expecting front loading to continue then? The export picture still looks the same?
Well, you have 3 weeks. Yeah. You got to front load really, really quickly, right?
So when does the data start to really turn, you think, Fred?
Yeah, I think, look, the front loading is still, we knew is already going through July anyways. If you look at what the U.S. retailers are forecasting in terms of the container imports, really April, May, June, and July is running at above year-ago levels. But then you see it drop off sharply into Christmas. So what they've done is essentially they moved the pre-Christmas shopping holiday purchases into the second quarter. And so there will be a payback regardless of what tariffs we'll get the second half of the year. And that's going to be a challenge for Asian growth.
President Trump has made it pretty clear that he's got BRICS in his sights and any country that he sees sort of aligning with that group as well. Do we need to be concerned about that having an impact, particularly in Southeast Asia?
So we don't have really details, right, around this. What does it mean? When does it kick in or not? I think the broader lesson here is that tariffs are becoming a broader tool, right? Initially, it was about, we have a trade deficit and we want to correct it from the perspective of the United States. And now it's sort of starting to be used for other purposes as well. You're doing something I don't like, so maybe I'll put tariffs on you. And so this is a widening of potential use of tariffs. And so it becomes a political rather than economic question.
Coercive, yeah.
And so that introduces a lot of uncertainty, actually, for businesses, because you don't know what the tariffs will be in the next 3 to 4 months, even if we get the deals. And I think that uncertainty in itself can be quite harmful for global trade, for cross-border investment, and it's something we'll just need to learn to deal with.
Yeah, I mean, he says he's going to slap more tariffs on, BRICS nations that have anti-American policies, for example. The trade deal with U.S.-Vietnam seems to be indirectly, in some ways, countering the transshipment of goods from China in some ways, right? Are we likely to see a significant dent to Chinese exports, for example, then?
Well, so far we haven't, right?
Yeah.
The Chinese export's still booming. And so the question is really the details. And this is with all trade agreements. These headlines that we get often don't really tell us much, because do these transshipment tariffs apply to pure transshipments or to components or not?
How you define
it really depends how it's actually implemented in practice, and we don't know as of yet. But ultimately, it's going to be problematic for China if all countries suddenly start to impose tariffs themselves as well. So it is a challenge for Chinese exporters, even if they're super competitive. That uncertainty itself will be a headwind for Chinese exports for sure.
Yeah, I mean, exactly to that point. You know, the devil really is in the details. We definitely don't have the contours of any real agreement just yet. So what does then, stripping it back and just sort of looking at base level right now, I mean, how do you assess the global economy right now? And do you think it's holding up maybe better than expected?
It's definitely holding up better than expected. Across the board, data is surprising, probably at the margin on the upside. Second quarter GDP is still coming in strong. The issue is, though, this is the calm before the storm, if you will, because the real impact of these tariffs on consumer spending in the U.S., on inflation, on trade flows, once the front loading kind of disappears, then we're going to get payback. And that's why we are looking at a slowing economy into the second half of the year, and certainly by the fourth quarter. We've got to see pretty weak numbers, not just in the U.S., but really across many export-reliant nations. And so as of now, it still appears that equity markets, for example, are taking the glass half full view here. Wow, you know, data is better than expected, and got a big, beautiful bill, tailwind for the U.S. But we haven't really fully seen the impact of all the trade uncertainty yet. But there must be some impact coming through.
Are central banks going to have to step in here in this part of the world? Are we going to see a much deeper sort of rate-cutting cycle?
We will, and they already did, right?
Yeah.
So you've seen rate cuts coming, still coming, and the issue is that the more you have tariffs in the U.S., the more you have deflation in Asia, because a lot of these goods that would have gone to the U.S. are essentially trapped outside the U.S. in Asia and depressing price levels, and that will open the door for central banks to cut rates, especially in an environment where the dollar is actually relatively weak. Because last year they couldn't cut because they defended their exchange rates. Now they're saying, okay, we don't care about the FX, but inflation is down and growth is down, so let's cut. And so there's going to be much more cuts to come. And that's, you know, that will last well into early next year.
So what's your expectation then of when we see the start to Fed easing? Because this has also been sort of jumping around, you know, mid-year, September, last week after the jobs figures. What do you see?
So we still see September. Now, the market has pushed it back. Or at some point a few weeks ago, we talked July, and everybody got really excited about it. Now the market's saying more like October. For us, it's September. It's really once the Fed comes back from summer holidays, and we get better sense of where the economy is going. So September is the first time we could see rate cuts. But in our view, the market's pricing in too many cuts over the cycle, right? So the market's looking at 125 basis points of cuts, huge easing cycle. I'm not so sure the Fed can actually deliver that much if you get the inflation from the tariff. So it might be stuck at 50, 75 basis points of cuts, and that's it, rather than this huge prolonged easing cycle.
What does that mean for the dollar? I mean, it seems like despite any sort of news, dollar still continues to be weaker. Do you see that as structural weakness? Or something that's more cyclical?
I think we need to be careful not to extrapolate first half of the year, right? Okay. Biggest depreciation since 1973, depending how you measure it, but it's a huge number. But if you think that the Fed will not deliver as many cuts as currently priced in, if you think that the tariffs will be quite disruptive for Asian growth, if you think that actually some of the currency moves were FX hedging and that will run its course because FX hedging is quite expensive, then that would mean that the depreciation pressure on the dollars will ease into the second half of the year. It doesn't mean a strong rebound, but it means that, you know, that we don't extrapolate this massive weakness that we had the first half of the year.
So, yeah, because we've been talking a lot about these dollar dynamics, and some of the economists or investors, traders are saying we could see maybe a further 5% appreciation in the dollar gauge from here through year end. But you're not saying that's going to be the case.
I think that's a tall order. I mean, it depends a little bit on how China plays its cards. Is China going to appreciate its currency? That could give Asian currencies a bit more tailwind. But, you know, even there, the Chinese are moving very, very gradually on the fixings because they're facing big tariffs. And we know from the first Trump administration that, you know, when faced with tariffs, the Chinese, back then at least, saw more of a depreciation of the currency rather than appreciation. So it's not clear why now the CNY should dramatically appreciate. So it does seem that, you know, be careful what you expect second half of the year. It's likely going to be more flattening out of the dollar rather than a further weakness.
I think, if anything, the second half of the year is shaping up to be pretty bumpy, given we just got this can kick down the road to August 1. But that was Fred Neumann, their chief Asia economist and co-head of global research Asia at HSBC. And subscribers, of course, can also turn to the terminal for more on this. T-Live Go is your function for the latest updates, plus commentary and analysis from our expert editors. But we'll have plenty more ahead. This is Bloomberg.
In some corporate headlines this morning, Bloomberg has learned that Nissan is planning to issue $4 billion in unsecured dollar and euro denominated junk bonds, part of an effort to fuel the automaker's turnaround. A source says the cash will be used for general corporate purposes, including refinancing debt, and are expected to price later on this week. That's on top of $1 billion of new convertible bonds Nissan announced on Monday. And Bloomberg has learned that Apple's top executive in charge of AI models is leaving the company for Meta. Sources say Roming Pang is joining Meta's new superintelligence team after being offered a package worth tens of millions of dollars per year. Pang joined Apple from Alphabet in 2021 and have been running a roughly 100-person team responsible for the company's large language models. Epic Games has settled its antitrust case against Samsung Electronics. The suit alleged that the electronics giant conspired with Alphabet's Google to block rival app marketplaces through default settings on Samsung mobile devices. The Fortnite maker says it's grateful that Samsung will address its concerns, but didn't elaborate further.
Taking a look at some movers in the session so far, just some reporting that's come from the Securities Times, but what they are saying is that New World Development is seeking to sell a portion of its K11 property in Shanghai. We know that New World's financing generally has been back in the spotlight. They're certainly looking at ways that they can shore up cash. They had been planning to raise up to $2 billion through a new loan, and that actually was backed by another K11, but this is the one at its Victoria Dockside asset instead. But we're watching that stock, also taking a look at what's happening with the automakers this morning, because of course a lot of the focus is on Korea and Japan that are bracing possibly for further tariffs, although the deadline for that has been set at August 1, and that is sort of a sense of relief perhaps that some investors have this morning for that being pushed down the road. More ahead. This is Bloomberg.
$11:29 a.m. in Tokyo. Japanese markets are heading into that lunch break in just a moment. Of course, we're still dealing with, of course, how we digest these latest lines and tariff announcements from the Trump administration. At least markets are taking it in stride here right now. In fact, seeing a little bit more relief, the fact that this tariff deadline, or at least the implementation of these tariffs, will be extended to August 1st. So Japan getting a higher, just slightly higher tariff rate. But then again, they got 3 more weeks to discuss and negotiate. We just heard from Kato-san as well, saying the Japanese government continues to assess the economic impact of these tariffs.
Yeah, and that's exactly what we've been speaking with guests about this morning, getting reaction to Trump's latest tariff threats throughout the shows. But take a listen.
We're trying to best plan and prepare in an inflationary environment where we already pay high duties, and we have a concern that while there's a reprieve for a number of weeks, we're going to continue to see high duties, and that will drive up prices for consumers. And I can tell you that our consumers are weary, they're worn down, but that's the environment we find ourselves in right now.
I'm sure that countries are not going to scramble to try to, fix a deal just before August 1, because you can't extend forever, right? Otherwise, the TACO kind of label really sticks. So I think there is some pressure really to come to some deals by August. But that really, the markets haven't reacted, and so really today is just a 3-week extension, more or less.
And for more on how markets are reacting, let's bring in Mark Cranfield, our MLI strategist, joining us from Singapore. Mark, it seems like markets are at least, glass half full right now, expecting, we have 3 more weeks to go before these tariffs are implemented. How should we be interpreting what's been going on in the White House? And it seems like a lot of the price action is really focused on the FX markets. Will it stay that way?
I think you've got a combination of things here. As far as equities are concerned, I think there's some hope here that worst case scenarios have been avoided. That's why you're seeing most Asian markets at least a bit higher today. It was only a week ago that Trump was talking about possibility of 70% tariffs on some people. That seems to have been avoided, especially for the ones that matter the most, people like Japan. So even if they do get tariffs imposed on them, it's not going to be as severe as it may have been. So that's something which is a bit of a relief to people. In the foreign exchange world, you still mostly have this idea that in general, investors would prefer that the United States didn't engage in trade wars at all, because it's seen as a kind of a self-harm for the US dollar overall. But you do have this one exception today, which is the Japanese yen is underperforming most of the other G10 currencies. Now, what's happening there is that the fact that Japan has still got to negotiate with the United States has got a limited time, and it comes when there's a Japanese upper house elections in less than 2 weeks' time. That is a worst-case scenario for Japan's leadership. The LDP, the ruling party there, was already looking at a very tight election anyway, and this heaps more pressure on their leaders as well, who already have a pretty low poll ratings as well. They're only seen as about 30% supported within the country going into this. So it's an absolute worst case scenario for the Japanese leadership, and that's being reflected in what's happening in the yen. That's got more to do with what could become a difficult political situation in Japan rather than the tariff situation, which they need to clear up as well. And as Fred Neumann was saying there from HSBC, there'll be a lot of pressure on people to get things done by August the 1st. And of course, Japan is working on that, but there's no certainty that they will be able to. So that's making the yen a relatively easy scapegoat for people in the foreign exchange market. They're looking for ways to play this. Obviously, they don't mind shorting the dollar a bit, but also they're shorting the yen as well against a whole series of currencies here.
Yeah, Japan doesn't really want to be looking like they're maybe offering too many concessions given those more domestic political factors. But in the interim, given we've still got now this new time frame, August 1, what's going to be most important, or what else will traders be tracking closely?
Well, you've also look at what it means for the bond markets as well. We're beginning to get an assumption that there will be tariffs to some extent. They might not be as bad as was being talked about earlier in the year, but tariffs are inflationary, definitely, over a longer period of time. So you're seeing yield curve steepening. There was another move last night in the Treasury curve that's being replicated across markets today, particularly pronounced in the Japanese markets this morning as well. We're seeing it in Australia and other places as well. That theme has been on and off to some extent, but mostly on over the past few months, and it looks as though it's going to have fuel to continue right through the summer here, because that clearly, if you've got America's just passed this huge bill, which is obviously going to add to situation in America where the deficit is going to widen, that's going to put pressure on long-term yields as well. You're seeing other countries having to issue more at the long end as well. Japan has tried to cut back slightly, but you can see the market has got its doubts about whether they're really addressing stagflation issues or not, and apparently they're not really, because the Bank of Japan is really taking their time. So this steepening of long bond curves is going to be in place for some time, and it isn't something which, whether the tariffs come on the 1st of August or they come later, it is going to fuel inflationary expectations anyway. So people seem fairly assured that whatever happens, equity markets can probably grind higher to a degree, but they're going to be held back partly by steepening curves, and that isn't something that's going to go away.
Mark, thanks so much for joining us this morning. That was our MLife strategist, Mark Cranfield, there. And also just taking a look at some of the more interesting or notable movers in the session so far today. And we're actually seeing SMIC rising here. And it's an interesting story because HSBC has upgraded the stock to buy. They actually had 8 shares that are reduced before, but they've lifted their price target to $64 Hong Kong a share, up from $35. What they're actually saying is that there's more scope for localized demand. So they're expecting SMIC to take on more market share locally. That currently sits at around 25% of the overall foundry business or foundry demand within China. They're saying that could grow even further, and is that continuing drive for self-reliancy, and SMIC has been a big beneficiary from that. Samsung, I mean, it's quite a different story for that one today, because they're actually at risk of all of the impact of China curbs from the US.
Yeah, it looks like it took a hit in the previous sort of earnings. So certainly that's one thing to watch here. The stock has basically been fluctuating between gains and losses. We're just slightly down for Samsung now, down about 0.6%. But the tech space overall in Hong Kong is actually doing quite well. We're seeing actually most of these tech names actually rallying here this morning.
Yeah, and just to note as well, just on that sort of chip story, because we just had some lines dropping, Taiwan is saying that they're still in talks with the US on tariffs. They're saying they haven't received any US notice just yet. Of course, we're waiting for perhaps more letters to be sent. But this is a really big talking point because Taiwanese chip companies are under so much pressure to send their more advanced semiconductor technology to the States.
Yeah, certainly that's what we want to watch. Taiwan, as we talked about, India. They said, our sources telling us that they've already put their best offer on the table. And EU. I think those three are some of the big ones to watch in the coming hours and coming days as well. Plenty more ahead. This is Bloomberg. All right, we're going to talk about Hong Kong's red-hot IPO market, right? We've got a big number to tell you about. The city has basically welcomed 45 new listings on its stock exchange so far this year, and it looks like there's more to come. Tomorrow alone, we'll see 6 trading debuts just into tomorrow. So certainly it's looking to be a really bumper year. And the deals keep picking up, right? You like to have the likes of PwC, the likes of Deloitte are now saying that Hong Kong is on track to regain its position as the world's top fundraising venue for IPOs in 2025, with an estimated 90 to 100 companies raising up to $25 billion. The city is really benefiting as Chinese firms seek fresh capital and with geopolitical tensions luring investors to shift cash away from the U.S. And Belle, it's very interesting, right? Amidst the sort of U.S.-China trade tensions, you're actually seeing Hong Kong benefit as a destination for a lot of these Chinese firms to come back home.
Yeah, that's right. It's actually such a fascinating story because, as you said, I mean, Hong Kong has been a market really exposed to US-China tensions. But what you're seeing this year is just a rebound in its equities. So the Hang Seng, for instance, you can see here that jump of about 20%. And again, it's really that sentiment that's been helped by the wave of multi-billion-dollar deals. So let's bring in our panel of guests. We've got Chui, head of Global Issuer Services at HKEX, and, of course, Nelly, head of Hong Kong IPO and Corporate Finance Group at JPMorgan. So thanks very much to both of you for joining this morning. But I'll start with you, Johnson, because I mean it's probably a really great moment to be sitting in your position at HKEX. So what's really driving it? It seems like a lot of it maybe is secondary listings or follow-on listings. You've got sort of Chinese companies looking to come to Hong Kong as well. I mean, what stands out to you so much the most so far?
Yeah, thank you and good morning. So we've enjoyed very strong momentum for the first half of the year, and really a few key themes and highlights. So on the IPO front, for the first half, over $14 billion have been raised. Hong Kong is the #1 IPO exchange globally in terms of corporate IPO fundraisings. Amongst the IPOs, we've enjoyed CATL, obviously, landmark transaction raised $5.3 billion. So it's been very strong. But what's really interesting is if you look through the various IPOs, the key thematics, #1, it's very broad-based across many sectors. So if you look at the IPOs completed, we've seen a lot of successful IPOs in the consumer retail sector, TMT, new energy, and more recently in the second quarter, a really proliferation of healthcare transactions as well. And then the second point is, when we look at these transactions, the investor participation has been quite broad-based. So a lot of international investors, regional Chinese investors, Middle East, and retail has also been back. So it's actually quite broad-based and quite strong.
Nelly, I'll get your take. How busy has it been for your team right now? And what confidence do you have that this momentum can continue here?
Yeah, there's actually a total of 228 A1 filings as of June 30th. 228 actually is a very lucky number. So we are talking to a lot of issuers, and I expect a lot of them will actually kick off the process very soon. So we do expect there will be a lot more filings coming in the third and the fourth quarter. So to us, this is really sustainable. Yeah.
And just give us more context. I mean, how many do you have in the pipeline right now? Could you share any figures for us, and how much is that changing?
The figure is definitely increasing, and then it's we have 228 for the first year. First half of the year, I'm sure that will be pretty much maybe increasing number for the second half of the year. Yeah.
Johnson, the mega deals like CATL, that certainly was the blockbuster one the first half. Are we likely to see some of these big deals come through too?
Yeah, so if you look at the key thematics and the buckets of deals and just extending on the pipeline, over 200 companies that have publicly filed. But if you look at the various categories, these like larger A2H transactions,
Yes.
following the CATL, the hung raise, that thematic will continue. So if we look at this bucket, for the AH transactions that have either publicly filed or have publicly announced their intention to do a second listing in Hong Kong, totals to over 50 of these companies. So that's one bucket. The second bucket is consumer retail, extending the momentum from the first half. We'll definitely see more companies from the consumer retail sector. But I think more importantly is new economy, tech and biotech. A substantial part of our pipeline is really on tech and biotech, and specifically as it relates to Hong Kong and HKEX, Chapter 18C, specialist technology. That's really a growing segment, and also Chapter 18A for biotech companies. For both of those chapters, we see a significant amount of companies that's publicly filed, and hopefully more to come.
Yeah, it's not just sort of like tech that's having a deep-seek moment, and we talk a lot about the biotech space having its deep-seek time as well. But Nelly, is there anything that sort of risks this optimism and anything that makes you think maybe companies might get a little bit nervous and then hold back? Could trade tensions be that, for instance?
Yeah, there's obviously a lot of attention around the trade situation and also the international relationships. But actually, enough time has elapsed, and then we do see strong confidence in the market, the reaction to it. So obviously, there will be probably short-term volatility around this, but I do see we are quite optimistic in the second half of the year. Yeah.
There's a lot of talk, Johnson, about the lack of sort of appetite for A-share listings. But we did hear from regulators last month saying that listings can actually increase here on the Chinex and the Starboard. They want to support innovation onshore. If we see some sort of A-share rebound in IPOs, is that going to hurt Hong Kong in any way, you think?
Well, the way that we see the Hong Kong market and A-share market, we're very complementary. And we have, roughly about 150 dual AH listed companies. So it's a well-trodden path, very complementary. What we focus on at HKEX and in Hong Kong is really the value proposition that a Hong Kong listing offers to issuers from China and internationally, and specifically for Chinese issuers, be it first-time issuers or AH second listing issuers, Hong Kong, really offers international capital markets access to international investors and capital. And you see, the other very interesting thematic is for a number of these AH companies, and also the upcoming batch of Chinese issuers listing in Hong Kong, a lot of these companies are going international. And what Hong Kong really offers them is a fantastic international capital markets platform to really support and aid their international business expansion.
Yeah, that's really one of the key advantages of listing here versus in the mainland. But what's the conversation been like with companies that are in other parts of the world? I'm thinking Southeast Asia, but Middle East, of course, is a really interesting dynamic as well.
Yeah, no, it's definitely a strong focus for us. So on the international side, and as you mentioned, on the ASEAN Southeast Asia side, we're definitely seeing some recent successes. So over the course of the past 6 to 9 months, we've seen quite a number of ASEAN companies from the e-commerce TMT space listing in Hong Kong, biotech, and more recently, last week, we had a Thai coconut water consumer name that was very, very well received. So we're seeing good successes and pipeline with international issuers. Going forward, additional work that we'll try to do more to really help international issuers list in Hong Kong. So on we've recently recognized more exchanges. We call it RSCs, recognized stock exchanges. Thailand has most recently been added, Middle East, Dubai, and Abu Dhabi. So we're doing a lot of that work to really bring more international issuers to list in Hong Kong.
Nelly, I got to talk about what we've been seeing is a lot of Chinese investment banks are part of these IPOs now.
Yeah.
What do book runners like JPMorgan do to fend off some of this competition from China right now?
Right. I think I echo Johnson earlier saying that a lot of these companies, they really want to come to Hong Kong to tap the international capital market. So I think, and given the fact that all these international investors, global investors are really coming back and showing a strong interest in this part of the world, so we definitely play a very, very important role in all these IPO offerings.
Are fees going to be impacted anyway then?
Well, it's always competitive, and I would say basically it's all the market rates.
Okay, sounds like maybe there's maybe some discounts, I guess, have to be offered. But in terms of as well, what sort of drives the demand? What is it going to be? Is it going to be IPOs or FPOs that really we see, say, toward the end of this year into the next?
Well, basically, that's a very good question. I think Hong Kong is good, obviously well known for our Hong Kong IPO markets, but follow-ons and also CBs and equity and exchangeable bonds. Also, we see a lot of deals on the pipeline. And in Hong Kong, there's only 5 billion above follow-on placement in the history, and we actually did see 2 of them launched in 2025. So we will expect a lot more follow-ons will be in the Hong Kong market.
Okay, before we go, I got to ask you then, do you think Hong Kong's going to take the top crown for IPOs this year? Yes or no, Nelly?
Yes.
Yes? Johnson?
We'll do what we need to do.
Very diplomatic answer. Johnson, great. So, Johnson Chui there, head of global issuer services at Hong Kong Exchange, and our thanks to Nelly Pai, head of Hong Kong IPO and corporate finance group at JPMorgan. You can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter. That's out every Thursday. You can sign up through our website, bloomberg.com/newsletters.
We've made a deal with China. We've made a deal. We're close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal. So we just send them a letter. If you want to play ball, you have to. This is what you have to pay.
President Trump there saying he's close to a trade deal with India. Of course, Indian markets are opening up in the next hour as well. And officials there are saying that they've made their best offer to the U.S. and the fate of any agreement now lies in the hands of President Trump. Let's bring in our South Asia economy editor, Rushi Bhatia. She joins us now with what to expect. So best offer on the table. What do we know so far about a potential deal here, Rushi?
Well, the U.S. President Donald Trump there shipping out letters, even as he said that he's very close to making a deal with India. As far as India is concerned, we do know that India has put its best foot forward and has put their best offer on the table. Of course, it is up to Donald Trump, U.S. President, to really take that deal forward. And also it depends on the Indian leader, Narendra Modi, as well, as to what will be the fate of this deal. Having said that, there are a few red lines that India has made very clear in their offer. One of them, of course, is the dairy sector, the fact that India will not open its market to GM crops. And this is, of course, coming in because, remember, farmers is a big constituency as far as the Indian government is concerned. In almost more than half of India's economy is dependent on the farm sector, and which is why it is going to be very hard for the Indian government to really get and give unprecedented access to the U.S. as far as the farm sector is concerned. Having said that, India also has raised its concerns and issues with 2 more things. One, of course, is the sectoral tariffs on steel and auto, and the other one, of course, is the issue of baseline tariff, whether the 10% baseline tariff will go. Having said that, over the next few days, we're hoping to get some clarity, but the Indian government has made it very clear that those red lines for them should not be crossed. There is a big domestic constituency that they have to take care of. The Indian opposition leader, Rahul Gandhi, has also been saying that the Indian government should not concede to the demands of the U.S., but we really have to see how it will play out in the next coming days.
That was Bloomberg's Ruchi Bhatia there joining us this morning. And of course, it's really that big focus on these trade decisions, these tariff deadlines that have also been kicked down to August 1. But in the shadows of that, we've got the RBA that's set to announce its first rate decision in about 90 minutes from now. The expectation is that we could see the first back-to-back interest rate cuts in 6 years.
Yeah, so that certainly is going to be a key thing. Is it all in the price? And keep in mind, the RBNZ has their announcement and decision the next day. So watch that Aussie-Kiwi cross very closely. But certainly, there's a lot of questions and expectation, maybe that they might see a third cut, which might be a tall order, but we'll see what the note and the tones are going to be from Michelle Bullock and her, of course, central bank there. We got more coming up with Insight with Haslana Ahmed.